Hi, I'm Todd Rosenbluth, head of research and Verify, and we're here at the Exchange Conference. I'm here with Rene Casis of American Century. Rene, thanks for joining me.
Thank you, Todd. Appreciate the opportunity to be here.
My pleasure. So let's talk about active growth strategies. There's some challenges in managing that in this environment, right?
Yes. So one of the main challenges that we've been seeing, and I think like many of the others have seen, is really the high concentration in the benchmarks that active funds are measured against. So if we think about the broader U.S. growth space, the top 10 represent almost 50% of those indices. So very highly concentrated. It could pose some risk, but especially when you have the Magnificent Seven driving most of those returns, it really brings about a lot of challenges in terms of how do we add value as active managers in the space. But there are opportunities. So if we think about the entire breadth of and the universe of U.S. growth, there's hundreds of opportunities to add value beyond the Magnificent Seven. But it is quite a challenge, especially when you're measured against something that's market cap weighted.
So how do you address that kind of a challenge?
So we do a couple of different things. We have a fund called the American Century U.S. Quality Growth ETF, ticker QGROW. And what we do there is we really focus on quality. So we screen out the universe for higher quality names. So we look for companies that have stronger balance sheets, more stable earnings growth, better asset, better management quality, lower leverage, and things of that nature. And we use a multitude of diverse different fundamental measures in order to screen out the lower quality names in the universe and really focus on those higher quality names. And then from there, we look at a diversified set of growth companies. So not all growth companies are created equally.
Right.
So we think about growth companies that are more traditional, higher momentum growth, but we want to balance that with companies that are growth companies, but are trading at a more attractive valuation. And we dynamically tilt towards higher growth and more stable growth, highly dependent on the economic conditions of the market.
So we have lots of advisors here at the Exchange Conference. How should they think of something like QGROW within their portfolio?
So the way we think about QGROW for client portfolios is really a way for advisors, investors to remain dedicated to their growth allocation, but be in a strategy that can withstand some of the gyrations and some of the volatility that can come with growth, with being invested in growth. So for example, in 2022, we saw value outperform growth for the first time in 20 years? Right. And then we saw that reversal come again in 2023, where growth started to make its comeback, and it's continuing to see that trend this year. But there's a lot of volatility in that, and it's very episodic. So one of the ways QGROW can help is that it can help advisors remain in that growth allocation and to be able to withstand that volatility when growth comes, particularly when growth comes out of favor, but still participate when growth has its upside.
Makes a lot of sense. So thanks for talking to me about QGROW here at the Exchange Conference. We'll see you next time.
Thank you.